Taxation is an important mechanism through which governments generate revenue to finance public services, infrastructure, economic development, and social programs. Taxes affect individuals, businesses, and other organizations and play a significant role in economic decision-making. Within most tax systems, taxes are broadly classified into two categories: direct taxes and indirect taxes. Understanding the distinction between these forms of taxation is essential for management accountants because taxes influence profitability, pricing decisions, cash flows, and financial planning. Direct and indirect taxes differ in terms of who bears the tax burden, how the tax is collected, and the economic effects they have on taxpayers and businesses. Direct taxes are taxes that are imposed directly on the income, wealth, or profits of individuals and organizations. The person or entity on whom the tax is levied is responsible for paying it directly to the tax authority and generally cannot transfer the burden to another party. Common examples include corporate income tax, personal income tax, and capital taxes. The amount payable usually depends on the taxpayer's financial circumstances, such as earnings, profits, or asset values. Because direct taxes are linked closely to the taxpayer's ability to pay, they are often regarded as an important tool for achieving fairness and income redistribution within society. One key feature of direct taxes is that they are generally progressive in nature. Higher-income individuals and more profitable businesses often pay a greater amount of tax, either through higher tax rates or larger taxable amounts. Direct taxes provide governments with a stable source of revenue and can be used to influence economic behavior through tax incentives, allowances, and reliefs. However, direct taxes may sometimes discourage work, saving, investment, or entrepreneurship if tax rates are perceived as excessive. Businesses must therefore carefully manage their tax obligations through effective planning while remaining compliant with relevant tax regulations and ethical standards. Indirect taxes differ from direct taxes because they are levied on goods and services rather than directly on income or profits. Although businesses often collect and remit these taxes to government authorities, the economic burden is usually passed on to consumers through higher selling prices. Common examples include value-added tax, VAT, goods and services tax, GST, sales taxes, customs duties, and excise duties. The taxpayer who ultimately bears the cost is generally the final consumer rather than the business collecting the tax. This characteristic distinguishes indirect taxes from direct taxes and influences their economic and social effects. A major advantage of indirect taxes is that they are relatively easy for governments to collect because they are integrated into commercial transactions. Revenue is generated continuously as goods and services are purchased, providing governments with a broad and reliable tax base. Indirect taxes can also influence consumer behavior by making certain products more expensive, such as tobacco, alcohol, or environmentally harmful goods. However, indirect taxes are often criticized as being regressive because lower-income individuals may spend a larger proportion of their income on taxed goods and services compared with higher-income individuals, resulting in a relatively heavier burden. In summary, direct and indirect taxes represent two fundamental approaches to taxation. Direct taxes are imposed directly on income, profits, or wealth and are paid by the person or organization on whom they are assessed. Indirect taxes are imposed on goods and services and are generally collected by businesses but ultimately borne by consumers. Direct taxes are often associated with fairness and redistribution, while indirect taxes provide efficient revenue collection and influence spending behavior. Understanding the features, advantages, and limitations of both forms of taxation is essential for financial reporting, business planning, compliance, and effective management decision-making.